Okay, let's look at how the spending multiplier or fiscal multiplier works. So first we need a tax rate. So we'll say that our tax rate is 20%. And now the idea is that the government is going to spend some amount of money. So we'll say that the government's going to spend $2,000 on some project. I guess it'll have to be a small one, say a teeny tiny little bridge. And the government spends this money. Some person or persons do the work. And so whoever that is going to earn the $2,000. All right, now these people are going to pay 20% of what they earn in taxes. So that's going to be $400. And then they're going to spend the rest, which will be $1,600. So however they're going to spend the $1,600, getting haircuts, buying clothes, buying food, whatever it might be, that's going to be income for some other group of people. And so that other group of people, group 2, they're going to have as income $1,600. And they're going to pay 20% of $1,600, which is $320 in taxes. Now this group 2, they're going to spend whatever they have after they've paid their taxes. So that's going to be $1,600 minus $320. That will be $1,280. Is that right? Okay, and this $1,280 that they spend is going to be income for group 3. Group 3 is going to pay their taxes. So $256. And they're going to spend the rest. So that will be 1,000. Okay, so this process is going to be ongoing, at least for a period. And the important thing about it, or what interests us, is how it affects aggregate demand. So initially, the government spent $2,000, and that's the only, call it new money, that's being introduced into our example here. But since it went to group 1 and group 1 spent it themselves, after group 1 had done that, GDP, well, aggregate demand and GDP, have increased by $3,600. So what we care about is the aggregate demand curve has shifted to the right by this amount. Okay, so then down here, we go through another cycle of this, and group 2 has spent their $1,280. So after that happens, aggregate demand again has increased. And then the same happens after group 3 spends their $1,024. Okay, so the government only spent $2,000, but after several cycles of this, the actual contribution or change to aggregate demand is $5,904. Okay, and so this process will go on. And we also have a formula for just calculating how much ultimately will be added to aggregate demand when the tax rate is, in this case, 20%. Okay, so we use this formula. One over 1 minus t. This is our tax rate. And there's a reason for giving you the formula exactly like this, but maybe you can tell that it reduces to just 1 over t. So if our tax rate was 20%, this formula is going to produce 5. Okay, so what does that 5 mean? That's the multiplier. That's how much this amount here will be multiplied as this process continues. So our initial expenditure was $2,000 multiplied by 5 means that ultimately $10,000 will be added to aggregate demand. Okay, aggregate demand will have increased by how much? All right, in the next video, then I will go through the same thing, slightly shorter example, where we have a tax rate and also we include savings.